Have you ever wondered why, despite working hard, saving every dollar, and trading daily in the United States market, you still cannot escape the spiral of losses and debt? It is not because you lack luck. It is not because the market is too harsh. It is because you are trapped in an invisible financial gravitational force. It is a carefully engineered trap that keeps retail traders spinning in place. Today, we are not discussing how to get rich quickly. That part is relatively simple. It is like the markup phase when you understand how to follow smart money and capitalize on strong upward momentum. Instead, we will examine the most difficult subject in stock investing: how to avoid financial poverty, how to avoid falling into a repetitive cycle of losses. It is similar to avoiding being trapped in the distribution phase and the markdown phase when the market shifts from accumulation to distribution and then declines. Most investors in the United States, especially retail participants, believe financial poverty simply means not having enough cash in a brokerage account. That is a serious mistake. Financial poverty is not a negative number on a screen. It is a powerful market force created by the behavior of the composite man. This term represents large operators, institutions, and professional investment funds. It is a closed-loop trap carefully designed to keep small investors stuck in short-term reactions and prolonged downtrends until their capital is completely depleted. I call this phenomenon the Wyckoff physics of poverty. If you truly want to understand why you remain stuck in a cycle of losses, you must view the market the way a rocket scientist views launch dynamics. A successful breakout from a trading range is like a rocket reaching escape velocity. Escape velocity means the speed required to break free from gravitational pull. Only when you accumulate sufficient cause, meaning enough preparation and positioning during the accumulation phase, can you generate a strong effect and enter a sustainable markup phase. Without that cause, no matter how hard you try, you will be pulled back and fall into markdown. Often you fall even lower than your starting point because panic and capital erosion amplify the decline. The frightening part is that this gravitational force does not only come from external factors such as price volatility or economic news. It also comes from your own reactions. Many investors in the United States work hard and save aggressively in order to trade, yet they fall into a familiar loop: small wins, large losses, then an attempt to recover by increasing trading frequency. The result is predictable. They never achieve true escape velocity. They never transition from survival mode to sustainable growth. That is why many intelligent and disciplined individuals remain stuck or gradually lose the wealth they spent years building. Understanding the Wyckoff physics of poverty helps you recognize the trap and identify the path out. Build strong cause. Be patient for the markup phase. Avoid emotional reactions that the composite man often creates to mislead the crowd. We will continue by analyzing the 5 primary chains that hold investors in place and how to break them systematically. To reach stable orbit, meaning a successful breakout from a trading range, you must achieve precise escape velocity according to the law of cause and effect in the Wyckoff method. The cause, meaning the accumulation developed inside the trading range, must be large enough to produce a powerful effect in the markup phase. If not, even if you commit 99% of your capital like fuel for a rocket, but the point and figure count does not project sufficient cause, the outcome will not be 99% of your profit target. Instead, you will fall back and crash into markdown. This is exactly what happens to many working-class investors in the United States. They work hard. They trade frequently to build a portfolio. They save carefully and attempt to break out of a downtrend. They climb halfway with modest gains. Then, unexpected events occur. Market reactions such as volatility spikes, sudden medical expenses similar to an abrupt drawdown, or job loss during economic recession. The market gravitational force, meaning supply and demand imbalance, pulls them back. They fall below their original level. Discouragement leads to emotional trading. Mental fatigue increases. Capital erodes more severely. History has shown this pattern many times. During the financial crisis of 2008, millions of retail investors attempted to climb higher by using margin. Many were swept away in markdown. The core reason is simple: linear effort produces little or no result. This reflects the law of effort versus result in the Wyckoff framework. You can work tirelessly. You can trade on a fixed schedule. You can maintain consistent volume. Without qualitative improvement, you remain stuck. Instead, you need exponential effort. Build significant cause during accumulation. Gradually build positions with patience similar to how the composite man accumulates near the bottom before advancing price. This approach reduces the market gravitational pull and transforms you from a victim into a participant with control. Successful investors, such as Warren Buffett, have applied this principle by waiting for a clear opportunity, sometimes described as a fat pitch, rather than swinging at every offer. The market may appear rigged against you, not because of a dark conspiracy, but because of mathematics. In the distribution phase, supply exceeds demand. Smart money begins to sell, price declines and traps retail participants. Consider the case of GameStop in 2021. Enthusiasm surged, momentum accelerated, yet many participants entered without sufficient cause. When the structure weakened, a downtrend followed. Recognizing these dynamics allows you to shift from emotional reaction to calculated action. Step by step, you can build the foundation required for true escape. The market is not mystical. It follows structure, behavior, and probability. Once you see the gravitational field clearly, you can finally design a trajectory that breaks free. One of the most overlooked yet critically important truths is this: financial poverty does not only make it difficult to become wealthy, it also makes you poorer at a faster rate. When your portfolio is small, every cost in the United States stock market becomes significantly more expensive. You cannot purchase large lots, so you pay higher commission and wider bid-ask spreads on each order. You do not have sufficient capital to own high-quality blue-chip stocks, so you often choose penny stocks or meme stocks because they appear affordable. These stocks can be destroyed by volatility within just a few sessions, like inexpensive shoes that fall apart after one rainy season. You also cannot afford a professional financial advisor or a high-quality analytical platform. As a result, you wait until the market collapses before taking action. It is similar to waiting until severe tooth decay develops before visiting a dentist. At that point, the cost of repair becomes enormous. A margin call, a forced liquidation, or panic selling at the bottom with a deep loss. That is when you realize you are paying a heavy price simply because your portfolio is fragile. Richard Wyckoff indirectly described this dynamic through his observations of the composite man. I prefer to frame it as the Vimes boots theory applied to the stock market. It is a simple but sharp idea. A wealthy investor can purchase high-quality shares at reasonable cost and hold them for many years, paying minimal annual fees. In contrast, a small retail investor can only afford low-priced stocks, must trade frequently, and absorbs commission-wide spreads, slippage, and high-margin interest rates. After 10 years, the wealthy investor has paid less. The poorer investor has paid 2 or 3 times more, and the account has not meaningfully improved. The structure of the United States market reinforces this reality. It penalizes small capital accounts, a margin call when price declines sharply, overdraft-type fees when leverage is used, margin interest rates that can reach 8 to 12% per year because the broker classifies the account as high risk. All these costs function like a heavy backpack on your shoulders while you are trying to run uphill. Meanwhile, smart money, represented by the composite man, moves with structural advantages: near zero transaction costs, narrow spreads, access to large blocks at favorable prices, earlier access to information. Millions of investors in the United States work hard, save carefully, and trade almost daily to climb upward. Yet they become poorer because of these invisible costs. They do not lose simply because the market is bad. They lose because they are competing in a system where the rules require smaller participants to pay the highest price. This is one of the first chains holding you in place. It also explains why linear effort, as discussed earlier, is rarely enough to achieve escape velocity. Understanding this version of the Vimes boots theory is the first step towards stopping the financial bleeding. The next chain to examine is the dopamine trap, which drives many investors in the United States to spend and trade based on emotion rather than market logic. This is the most dangerous part, and very few investors in the United States truly recognize it. Financial poverty does not stop at external damage such as portfolio drawdowns or high transaction costs, which we have already discussed. It goes deeper. It gradually alters your brain. When you remain trapped for too long, like a retail trader in the United States who repeatedly loses during a prolonged downtrend, your neural pathways begin to reorganize. You are pushed into a constant fight or flight state. In trading, this appears clearly as fear of missing out when a stock suddenly surges, or fear, uncertainty, and doubt when the market becomes volatile. You stop thinking logically. You begin reacting on survival instinct, like an animal being chased. The result is a decline in effective intelligence, not in a literal sense, but in decision quality. You start chasing price spikes. You buy near the top because the crowd is excited instead of patiently waiting for confirmation from a point and figure chart as taught by Richard Wyckoff. You stop planning for the next 10 years, such as building a long-term value investing portfolio. Instead, you focus on the next 10 minutes, jumping into risky day trading reactions. During the pandemic in 2020, many investors in the United States traded constantly to recover losses from lockdowns. The more they traded, the more they lost because stress had impaired clear judgment. You become reactive rather than proactive. That is the core of the poverty loop in the Wyckoff framework. Low returns, meaning small or negative profits, create stress. Stress produces market anxiety and sleepless nights spent watching charts. Stress then leads to poor decisions such as impulsive trades, panic selling at the bottom, or excessive use of margin. Poor decisions result in asset depletion. Positions are liquidated. Accounts approach zero. With no assets, returns remain low. The cycle restarts. This vicious loop is frighteningly efficient. It is reinforced by imbalance under the law of supply and demand. When supply from the composite man exceeds demand from retail participants, price declines. And when your brain is already fatigued, you are more likely to make costly mistakes. Despair is unnecessary because an exit path exists. You must generate sufficient thrust. That means aligning with the composite man, learning to identify the accumulation phase, avoiding the distribution phase. Thousands of investors in the United States have done this. Some began with small portfolios during the financial crisis of 2008. Today, many have achieved financial independence. The next step is to reverse engineer this trap by examining 5 specific chains. We begin with the scarcity tax, the silent pressure that gradually drains cognitive energy day after day. In this analysis, we will reverse engineer the financial poverty trap, similar to how Richard Wyckoff analyzed market behavior to shift advantage away from the composite man. We will apply Wyckoff's 5-step approach. We will treat the 5 chains holding you back as barriers inside a distribution trading range. These are the obstacles that prevent retail traders in the United States from achieving a breakout and instead push them into markdown. By identifying and breaking each chain, you can move from being a victim to becoming a participant with control. It is the difference between chasing pump and dump schemes and building a structurally sound position. The 5 primary chains are as follows. First, the scarcity tax. This drains your cognitive capacity, similar to effort that produces no result under the Wyckoff framework. Financial stress prevents long-term thinking. You focus only on short-term reactions, which leads to repeated losses. Second, the dopamine trap. This mechanism steals capital in the same way investors buy near a distribution top after smart money has already sold. You trade based on emotion. You chase rapid gains in meme stocks. The outcome is often debt and regret. Third, the linear income trap. This represents a severe waste of time. It is similar to failing to build cause during accumulation. You trade on a fixed schedule and generate small linear profits, but you never exceed inflation or overcome structural market costs. Fourth, social gravity. This is the crab bucket effect. It resembles following the retail crowd during a false uptrend. You are pulled back by friends or online communities, including groups on Reddit, where loss acceptance becomes normalized and breakout attempts are discouraged. Fifth, the compound void. This is being positioned on the wrong side of the cause and effect relationship. You pay interest instead of earning it. For example, you borrow on margin to trade without holding productive assets that generate returns. Finally, I will explain how to build your own engine. This means constructing your personal accumulation phase in order to generate the escape velocity required to leave financial poverty permanently. Once orbital breakout occurs, friction from excessive costs and psychological stress diminishes. Stability replaces chaos. You can operate within a markup phase characterized by sustainable profit. Before that, you must survive the launch. This requires passing 9 buying and selling tests within the Wyckoff framework, from identifying preliminary support to recognizing the last point of supply. It is a disciplined journey. Yet thousands of investors in the United States have completed it, including those who survived the dot-com bubble of 2000 and later benefited from long-term compound growth. We now begin breaking the first chain. We begin with the first chain, the scarcity tax. This is the force that quietly drains your mental capacity every single day. Most people, including many investors in the United States, assume that money alone solves financial poverty. They look at lottery winners who receive millions of dollars and believe that sudden capital is the ultimate solution. The harsh reality is different. A large percentage of lottery winners in the United States return to bankruptcy within 3 years. The reason is simple. Financial poverty is not only a shortage of cash, it is a shortage of cognitive bandwidth. Cognitive bandwidth refers to the mental capacity required for planning, analysis, and disciplined decision-making. When that bandwidth collapses, the brain shifts into survival mode. It resembles a high-volume market reaction when price swings violently and clear thinking disappears. Research conducted at Harvard University and led by Sendil Mullainathan demonstrated that financial stress can reduce effective intelligence by as much as 13 points. This decline is comparable to staying awake for 24 hours or functioning under chronic alcohol impairment. In practical terms, you are operating with a damaged processor. You cannot recognize long-term setups. You cannot construct strategic positions using Wyckoff principles. Instead, you focus only on surviving the day. That survival focus produces repeated poor decisions. This is the scarcity trap. Limited bandwidth generates flawed decisions. For example, borrowing on margin at excessive interest rates in order to trade quickly, or purchasing low-quality speculative positions with extreme volatility and no fundamental analysis. The issue is not a lack of intelligence. The issue is exhaustion caused by constant financial pressure, daily expenses, utility bills, unexpected margin calls. Meanwhile, the composite man representing institutional smart money understands this psychological vulnerability. During the distribution phase, they sell into retail demand. Retail participants buy impulsively due to fear of missing out. Supply exceeds demand. Imbalance intensifies. The pattern repeated in the United States during the cryptocurrency bubble of 2021, when many investors borrowed capital to chase rapid price appreciation, only to experience severe losses once momentum reversed. Revisit the logic of the Vimes Boots theory for clarity. A wealthy investor can purchase high-quality shares for $50 and hold them for 10 years. The effective annual cost is minimal. A poorer investor has only $10. That investor buys low-priced shares that deteriorate in value within 1 year. Replacement becomes necessary. After 10 years, total expenditure reaches $100, yet performance remains weak. The poor pay more per unit. In trading terms, this appears as wider spreads on small orders, higher slippage in micro-lot transactions, late fees from missed obligations, overdraft charges, and elevated borrowing rates because the account is labeled high risk. Poverty becomes expensive in every dimension. How do you break this loop? You build a financial buffer. Your first objective is not immediate wealth creation. You are not yet in the markup phase. Your initial target is to accumulate $1,000 or even $500 in a separate account that remains untouched. This is an emergency fund. It functions like a stop-loss buffer in trading. It prevents forced liquidation during volatility. More importantly, it restores cognitive bandwidth. It improves sleep quality. It stabilizes decision-making. It allows you to perceive long-term market structure, including extended trends described in the Wyckoff method. Many investors in the United States skip this step. They attempt to invest aggressively without a foundation. It is like constructing a skyscraper on unstable ground. The correct sequence is to drain the swamp first, strengthen the base, acquire durable assets, accept temporary austerity similar to a focused monk mode period in order to reclaim freedom from the scarcity tax. Thousands of investors who began with modest buffers after the financial crisis of 2008 eventually developed resilient portfolios. The next chain to examine is the dopamine trap, the mechanism that drives emotional trading and quietly steals long-term financial security. We now move to the second chain, the dopamine trap. This is the most emotional of the 5 chains. If the scarcity tax drains your cognitive capacity through constant stress, the dopamine trap steals your money through impulsive decisions. You attempt to treat the pain of financial struggle by spending emotionally. You have likely heard familiar criticism in the United States. If someone is poor, why purchase the newest phone, expensive shoes, or dine out when there is food at home? It is easy to judge from the outside, but the explanation lies in biology. When you are trapped in the poverty loop, as millions of retail investors in the United States experience, financial life becomes painful. Cortisol, the primary stress hormone, remains elevated. It resembles continuous market volatility with no stability. You feel small and invisible within the current of Wall Street where institutional capital dominates. Your brain demands relief. It seeks a small victory to reduce discomfort. When you enter a store or click a purchase online, acquiring a luxury item triggers a surge of dopamine. Dopamine is the neurotransmitter associated with reward and motivation. The emotional pain fades temporarily. You feel successful, you feel valued. The effect may last only minutes. This is not ordinary consumption. It is self-medication similar to applying a numbing agent to conceal the reality of a shrinking portfolio. The trap is simple. Relief lasts 20 minutes. Debt can last 20 years. Within the Wyckoff framework, this resembles buying at a distribution top. The composite man has already distributed shares. You react emotionally and purchase liabilities instead of assets. The fundamental difference between wealthy and financially distressed individuals lies in their interpretation of money. Those who struggle often see money as a tool to purchase immediate pleasure, similar to buying meme stocks at a peak because of fear of missing out on online forums such as Reddit. Wealthy investors view money as a tool to purchase freedom. They accumulate assets during depressed conditions and allow those assets to generate returns. When a struggling individual receives $500, the question becomes, what can I buy today? A disciplined investor asks, how can this capital work for me? Assets place money into your pocket. High-quality equities generate returns even while you sleep. Liabilities remove money from your pocket. A luxury item typically depreciates immediately after purchase. Millions of lower-income Americans are burdened with liabilities. Expensive vehicles, fashion purchases, unnecessary subscriptions, the latest electronic devices. Outwardly, the image may appear prosperous. In reality, wealth is eroding daily. Dopamine is being fed. Long-term financial stability is being starved. During the technology sector decline in 2022, many younger investors purchased consumer goods to feel successful after market losses. Credit card balances increased. Portfolios continued to contract. Breaking this loop requires intentional discipline. Enter a temporary period of extreme simplicity, sometimes described as monk mode. Not permanently. A defined period such as 6 months designed to reset the brain's reward system. Eliminate non-essential expenses. Cancel entertainment subscriptions. Reduce dining out. Avoid purchasing new clothing unless necessary. Focus on essential categories such as food, housing, and basic transportation. The process may feel uncomfortable. Social circles may not understand. The objective is not deprivation. The objective is training. It parallels the accumulation phase in the Wyckoff method. You build cause quietly before expecting markup. When you stop extracting dopamine from spending, neural pathways gradually adjust. You begin to experience satisfaction from watching your savings increase. That is the dopamine of control. It is durable and constructive. Once you realize you do not require the newest device to feel secure, you become resistant to manipulation. Financial marketing, speculative hype, and pump and dump promotions lose influence. Many investors in the United States adopted similar discipline after the subprime crisis of 2008 and later achieved full financial control. The next chain to examine is the linear income trap, the mechanism that consumes your most limited resource time. Following the dopamine trap, which drives emotional spending and quietly steals your future, we arrive at the third chain, the linear income trap. This trap is especially common in the United States, where most people are taught a simple life equation: time equals money. If you want more money, you must work more hours. Take a second job. Work overtime. Drive for a ride-sharing platform on weekends. This is a classic working-class mindset that dates back to industrialization. It hides a fatal flaw. Time is finite. You have 24 hours in a day. You must sleep. You must eat. You must care for family. Your income, therefore, becomes mathematically capped. There is an invisible ceiling that no amount of effort can break. It resembles trading with fixed volume while failing to build cause in the Wyckoff framework. Your expenses, however, are not capped. They are open-ended. This is where the silent killer appears: inflation. Inflation functions like a tax on those who sell their time. When the central bank expands, the money supply, prices rise. Food costs increase. Fuel costs increase. Transaction costs in financial markets increase. Wages, however, are sticky. That means they adjust slowly. An employer may raise salary by 3% after 1 or 2 years, while inflation has already reduced purchasing power by 8%. You are running upward on a downward moving escalator. The escalator moves faster than you can run. Consider the period of elevated inflation in the United States during 2022. Millions of individuals worked in the gig economy, including ride-sharing and delivery services. Many worked more hours. Yet by the end of each month, they were financially worse off because living expenses rose faster than income. You respond by working harder. You sell more hours. You sacrifice health. You miss family milestones. At the end of the year, you are poorer than when you started. This pattern mirrors a well-known definition often attributed to Albert Einstein repeating the same action while expecting a different result. Many retail investors in the United States fall into a similar pattern. They trade more frequently to recover losses. They attempt to defeat a structurally unfavorable game by playing harder under the same rules. The correct response is to change the game. Stop selling time. Start selling value. Build cause that can generate exponential effect rather than linear output. The practical method is to build a skill stack. Do not attempt to become the best in a single crowded field. That environment resembles competing against algorithmic trading firms on Wall Street. Instead, become competent in 2 or 3 unrelated skills and combine them. The combination creates rarity. Scott Adams provides a useful illustration. He was not the best illustrator. He was not the most accomplished humor writer. He was not the most experienced business executive. By combining drawing humor and corporate insight, he created Dilbert and achieved unusual success. The power came from stacking skills. For a lower-income investor, the implication is clear. Do not simply take a second hourly job that produces additional linear income. Use disciplined time freed through simplified living to acquire a complementary skill. If you work in construction, learn sales. You transition from laborer to contractor capable of closing larger contracts. That resembles building a position during accumulation. If you work in hospitality, learn persuasive writing. You move from serving tables to designing high-margin menus that increase revenue. You become a double capability professional. Income begins to detach from hours. You become harder to replace. You shift from commodity to asset. The United States market rewards rarity, not effort alone. If your role can be replaced quickly by a teenager or automated system, income pressure will persist. You must build a moat around your earning capacity. In financial language, you construct protective boundaries similar to the structural limits of a trading range in the Wyckoff method. The moat protects against automation and global competition. Many American entrepreneurs escaped the linear income trap after the recession of 2009 by combining technical skills with marketing expertise. The next chain to examine is social gravity, the force that pulls you backward through the influence of your immediate environment. Now, after breaking the linear income trap by building a skill stack and shifting from selling time to selling value, we face the fourth chain, social gravity. It is an invisible force, yet extremely powerful. It keeps you anchored by the very people around you. It resembles herd mentality in retail trading under the Wyckoff framework, where the crowd often chases a false uptrend without recognizing that a distribution phase is approaching. A well-known statement in the United States, often emphasized by Jim Rohn, says that you are the average of the 5 people with whom you spend the most time. If your 5 closest friends are broke, their portfolios shrinking, lacking ambition to build long-term assets, or constantly complaining about the economy, about the Federal Reserve, or about inflation, then you will become the 6th person. It is only a matter of time. The reason is simple. Humans are mimicking machines enabled by mirror neurons in the brain. We unconsciously copy the behavior, language, and mindset of the tribe around us. In trading, this is retail herd mentality. You see friends on social media chasing meme stocks, such as GameStop in 2021, and you follow without analyzing cause and effect through the Wyckoff method. If you are trying to escape financial poverty, building a buffer, entering monk mode, learning new skills, yet you are surrounded by people who have accepted poverty as a permanent condition, then you are fighting a losing battle from the start. They do not intend to harm you. However, their comfort with the status quo will pull you back, just as retail traders get trapped in a downtrend by joining a panic sell-off. This leads to the crab bucket effect, a common metaphor in the United States. When one crab is placed in a bucket, it can crawl out easily. When 10 crabs are inside, as one attempts to escape, the others pull it back down. They are not malicious. Your success creates discomfort because it highlights their own confinement. In real life, when you enter monk mode, begin saving capital and build a skill stack, old friends may react. They may say, "Why are you working so hard? Just relax." They may ask, "Do you think you are better than us?" They may claim the game is rigged, so why bother trying? This is the sound of social gravity. It echoes across forums such as Reddit and Wall Street Bets, where thousands of retail investors share victim narratives to comfort one another, yet unintentionally reinforce long-term financial stagnation. Financial poverty often becomes a culture. It is built around a victim narrative. The government is bad because of monetary policy. The wealthy are evil because they manipulate markets. Bad luck explains a bear market. This narrative provides emotional comfort and removes personal responsibility. At the same time, it keeps you poor. It is similar to retail traders blaming the composite man instead of learning to align with institutional accumulation and distribution. This pattern repeated across many communities in the United States after the recession of 2009. Many people chose complaint over action. A decade later, they remained trapped in low-income conditions. How do you break this loop? Practice ruthless isolation. This does not mean being cruel to family or childhood friends. It means protecting your mind. You cannot spend 3 hours each day listening to complaints about life. That is psychological poison similar to fear, uncertainty, and doubt noise in financial markets that pushes you to sell at the bottom. Find a new tribe. You live in the internet age. You can connect with virtual mentors. Spend time with the ideas of Charlie Munger, Albert Einstein, and other great thinkers through books, podcasts, and interviews. Let their voices override environmental noise. When you read the biography of a billionaire such as Elon Musk or Warren Buffett, you are installing their operating system into your cognitive framework. You are guiding your mirror neurons to model successful mental patterns. You choose to become the average of the authors you study, not the average of neighbors or online communities driven by fear of missing out. This is how you escape zip code gravity and construct a new intellectual neighborhood within your own mind. Thousands of investors in the United States have done exactly this. Some left negative group chats on Discord. They began following the disciplined reasoning of Charlie Munger. Over time, they achieved structural breakouts in both mindset and portfolio performance. We will conclude with the fifth chain compound, void the true engine behind wealth creation. After escaping social gravity through ruthless isolation, and by finding a new tribe via virtual mentors such as Charlie Munger, we arrive at the final chain compound, void. This is the true engine of wealth, yet it is also a lethal vacuum if you stand on the wrong side of it. Albert Einstein famously said that compound interest is the eighth wonder of the world. The one who understands it earns it. The one who does not understand it pays it. In the United States equity market, this statement is more relevant than ever. Compound interest is not merely mathematics. It determines whether you are a victim or a winner under the law of cause and effect described in the Wyckoff methodology. If you are trapped in a poverty loop like millions of Americans struggling with debt, then you are on the wrong side of the equation. You pay compound interest instead of earning it. You carry credit card debt at 20% interest. You finance a vehicle. You hold student loans, which are widespread in the United States, where total student debt exceeded $1.7 trillion in the year 2023. Each morning you wake up poorer than the night before, even if you did not spend a single dollar. It is like rowing upstream, while the current of inflation and rising living costs moves faster than your strength. Mathematics works against you. Your net worth erodes gradually, similar to a prolonged markdown phase without sufficient cause to produce a breakout. On the other side stand the wealthy, the smart money in Wyckoff terms. They earn compound interest. They allocate capital to the Standard & Poor's 500 index, to real estate, or to profitable businesses. Each morning they wake up wealthier than the night before, even if they slept all day. This is the snowball effect. Capital grows larger as time passes. Consider Warren Buffett. He began compounding capital in the 1950s. Today, Berkshire Hathaway stands as a living demonstration of long-term compound growth. Historically, the Standard & Poor's 500 has delivered an average annual return of approximately 10% over multiple decades. $10,000 compounded patiently can become millions, but only if you are on the earning side, not the paying side. To escape low income and financial poverty, you must stop paying interest and start earning it. You must cross the line under the law of cause and effect, building sufficient accumulation to generate exponential outcomes. Stage 1 is survival. Stop the bleeding. Reduce expenses to the minimum necessary level. Use disciplined savings from a simplified lifestyle to eliminate high-interest debt. You must eliminate the vampire that drains your cash flow, such as credit card balances or margin loans with excessive rates. Many Americans remain stuck here because of student loan burdens. Those who took decisive action after the financial crisis of 2008 achieved freedom far sooner. Stage 2 is accumulation. Begin purchasing productive assets, not a larger house, not a luxury vehicle. Acquire assets that generate returns. Allocate $10 per day, even just $10 into a low-cost index fund, such as the Vanguard Standard & Poor's 500 exchange-traded fund. Ignore financial media noise. Disregard glamorous trends on short-form video platforms or on business television networks such as CNBC. Simply buy a fractional ownership stake in the American economy and allow it to grow. Your snowball will appear small at first. It may seem insignificant. Trust the mathematics. Compound growth transforms modest contributions into substantial capital over time. Employer-sponsored retirement accounts such as the 401k have enabled millions of Americans to retire securely through this mechanism. Stage 3 is freedom. This is the moment when your assets generate sufficient cash flow to cover your essential living expenses. It is escape velocity. You break free from gravitational pull. You are no longer required to sell time merely to survive. You gain options. You gain dignity. You can participate in markets by choice, not from urgency. Many American investors reach this stage in their 50s, including participants in the financial independence retire early movement, because compound growth finally works in their favor. Understanding compound void does more than prevent mistakes. It transforms it into your most powerful financial weapon. The next step is to review the 5 chains and convert insight into immediate action. Now we have walked through all 5 chains. They are 5 barriers inside a distribution trading range under the Wyckoff framework. They are the forces holding you and millions of retail investors in the United States inside a loop of financial poverty. Let us review them one final time to see the full picture. First, scarcity tax. Financial stress depletes cognitive bandwidth. It prevents you from recognizing long-term setups and leads to poor decision-making. Second, dopamine trap. Emotional reward-seeking drives fear of missing out. You purchase liabilities near a distribution top instead of accumulating productive assets near a market bottom. Third, linear income trap. You exhaust your time by selling labor hours rather than building exponential cause through a diversified skill stack. Fourth, social gravity. Herd mentality, victim narratives, and the crab bucket effect from your surrounding environment pull you backward. Fifth, compound void. You stand on the wrong side of the equation. You pay interest instead of earning it. Your net worth declines each day, even when you spend nothing. These 5 chains bind you tightly. They resemble invisible barriers during a distribution phase engineered by the composite man to trap retail participants. Yet there is a crucial truth. The chains appear metallic, but they are forged in your own mind. They are shaped by emotional bias, fear of loss, fear of missing out, and the habit of reacting instead of acting with intention. The cage door has always been open. It was never locked. The system, meaning large institutional operators and market structure, negative peers, and your own fear, all prefer that you remain inside because change creates discomfort. However, you possess an advantage. The structural logic of the Wyckoff method supports you. The law of cause and effect, the principle of effort versus result, and the dynamics of supply and demand imbalance are objective guidelines. They are not biased. You already have a map, the 5-step Wyckoff approach to identify accumulation, avoid distribution, and participate in markup phases. One final element remains: courage to step out. Align with smart money by patiently building cause. Begin accumulation today, even with $10 per day allocated to a low-cost index fund. Trust the mathematics of compound growth. Thousands of American investors have done exactly this, from those who rebuilt after the financial crisis of 2008 to younger participants in the financial independence retire early movement. They no longer sell time merely to survive. They have options. They have dignity. They have genuine financial autonomy. That is the conclusion. You do not need to wait for a perfect opportunity or a dramatic price surge. You need to begin with discipline, patience, and confidence in the market principles articulated by Wyckoff. Thank you for reading to this point. Even partial implementation of these ideas can materially transform your portfolio over the coming years. May you achieve a decisive breakout and advance confidently through the next markup phase.